Hi, I'm Matt Davidson, and this is my brother James Davidson, and together we manage the Davidson Law Group. We're a comprehensive estate planning, elder law, and probate law firm. We're excited to be here today with Gabe Pelphrey. Gabe has an advisory and advanced business planning techniques practice. Gabe, why don't you tell us a little bit more about your practice?
Sure, and it's great to be with you and James today. Name of the company is Strategic Legacy Partners, and we are a company that focuses on really high-level advanced business planning strategies for corporations, nonprofits, banks, credit unions, so a pretty diverse client base.
And so today we're going to be having a conversation about some of those advanced planning techniques as it relates to business owners, as well as some tax strategies using trust. So if you are a business owner or you have highly appreciated assets and you're looking to do some tax planning, I think you're going to really draw a lot of value from this video today.
We're excited about the conversation today. I hope you enjoy.
The first topic that we're going to cover today is a charitable remainder trust. I've noticed in a lot of the advanced planning that we're doing that charitable remainder trusts are making a big comeback. So James, could you tell us who would that benefit and who are using charitable remainder trusts?
Sure. Well, a charitable remainder trust at its core level is an irrevocable trust that's used for tax planning and charitable planning purposes, and sometimes a combination of the two. And so somebody might, if somebody is doing tax planning, maybe they have a highly appreciated asset, or they're wanting to benefit a beneficiary with a large qualified account. Well, looking at charitable remainder trust as an option is often a good idea.
Okay. So a lot of tax planning is done there, and it sounds like tax deferral is also accomplished through a charitable remainder trust. Could you walk us through a real life example of what a client's done or how you've worked with the client to use a charitable remainder trust?
Yeah, absolutely. And so you have to understand that this is complex trust planning, so it's hard to really grasp the concept in a few-minute video. But to give you an example, I have a client that owns a surgical practice, and we are selling her surgical practice, and we'll just call it for an even $3 million. And so what we're going to do is we're going to fund her real estate and her business into this trust, and we're going to sell the business in the trust. And so instead of her selling it for $3 million and then immediately cutting a check to the IRS for whatever her tax liability might be, we're going to fund that trust with the whole $3 million and have the full spending power of the $3 million to invest and within the trust, and then ultimately defer out the taxes over the rest of her lifetime as retirement income. And then when the money comes out, the money gets taxed as it would initially. And so we're stretching out that tax liability over a long period of time and maintaining the full spending power of that $3 million within the trust. Okay? And so that's one example. Another example is a client that I have that has a piece of investment property. It's a rental property. And he's in his 60s, and he came to me and he said, James, I've done many 1031 exchanges over my lifetime, and I've decided that I don't want to be in the rental business anymore. I don't want to deal with tenants, and I really don't want to be a landlord. I'm just not in that phase of life anymore. And so instead of using a 1031 exchange to then buy another piece of rental property, we're going to fund this highly appreciated property into a charitable remainder trust and do the same thing. And so we're going to sell it for $800,000. We're going to contribute that property to the trust and then sell it in the trust. And so immediately he's going to realize that full $800,000, not going to have to pay any taxes on it initially, and he's going to invest it, and he's going to earn within the trust. He's going to earn on that full $800,000. And then, in conjunction with his CPA, we're going to plan out how he's going to realize that money, or take that money out over the course of the rest of his life. And so those are some real life examples. And so really kind of the that you have to take a certain amount every year, okay, starting at an ascertainable date, and at the end of it, at least 10% of the original principal amount has to go to a charity, okay? And so that's where it gets the name Charitable Remainder Trust, because it has that 10% charitable remainder component. And so it's a really useful strategy in certain types of tax planning situations.
That's great.
Yeah, and James talked a lot about the use of the Charitable Remainder Trust for capital gains tax deferment and savings, but also in the wake of a new piece of legislation that came down in December and went into effect January 1st, the Secure Act, which completely overhauls the way that inherited IRAs and 401ks are treated. There's another great use for charitable remainder trusts. In the old way, before the law came down, anybody who inherits an IRA or 401k would have the ability to stretch out the income tax that would come owed on that over their entire lifetime. This was a great tool for people because a lot of adult children who inherit these things from their parents, they're already earning their own money, and then now they have this extra income tax liability on top from their inheritance. And we don't want the inheritance and the legacy of our clients to be a burden. So the use of charitable remainder trusts with IRAs and 401ks can actually mimic the old law that allowed the children or any beneficiaries of an IRA to stretch out the income tax owed on an IRA or a 401k over their entire lifetime, as opposed to what the Secure Act does, which makes them pull it all out within 10 years. If you have a $3 million IRA that you have to pay the tax on over a 10-year period on top of what you're earning, that's a major burden to someone who inherits one. So the use of a charitable remainder trust can actually defer income tax and save on income tax and let money grow tax-free, tax-deferred for a longer period of time, much like the way that James was talking about it being used for capital gains tax.
So charitable remainder trusts are very powerful in doing tax planning, inheritance planning, or general succession planning, as well as selling a business. So charitable remainder trust, very flexible tool that can be used in a lot of different ways.
Yeah.
Exactly.
Fantastic.
So Gabe, in our practice, we help a lot of business owners with some advanced business planning techniques. And one of the topics that comes up quite often is, issues or problems with commercial insurance. And so what are some of the problems that you see business owners facing as it relates to commercial insurance?
Well, in the current economic environment, two of the major problems that I see inside of commercial insurance is that low loss ratios are not being rewarded. So it's taking money out of the business owner's pocket from the standpoint they're not being able to share in the savings of those low loss ratios. And another thing that I'm seeing is that there's a lot of types of risks that business owners want to get covered, but they're not able to go out into the commercial insurance marketplace and get those things covered. All right, that can be cybersecurity risk. It can be the risk of a government fine. And right now, a very hot topic is with COVID and finding insurance that would cover a pandemic or a COVID outbreak and would cover the risk that the business owner currently has from those types of events.
Sure. So, you talked about some of the problems that you see. What are some of the planning solutions that business owners should be considering in this arena? And can you tell us a little bit about what those solutions might do and why they might consider them?
Sure. The biggest solution that I'm seeing right now is a strategy that's a captive insurance strategy, where these high net worth individuals or these business owners actually go out and establish their own insurance company. And there is several different benefits to that. The first one being that any premiums that are paid from their business to that captive insurance company are tax deductible. So there is a huge tax benefit to doing it. But the business owner now essentially owning their own captive insurance company, they can go out into the market and they can insure these risks that they can't go out and insure through typical commercial lines of business. So captive's a very flexible tool. A lot of different business owners and high net worth individuals use them for different purposes, but one of the primary ones is they've got risks associated with running their business and they can't get good insurance for it.
So how does that look in application? So I'm a business owner and I come to you with this issue and you propose this captive insurance as a solution. So how do you work with the business owner? Do you establish this entity? Do you help them find the insurance? So how does that look?
Yes, so it's comprehensive. So we come in and work with them to establish their own captive insurance company. And then it is a very customized approach that we take to doing the tax and the business planning. And we bring in actuaries and say, okay, the actuary will look at this business and say, what all risks do they really have? the actuary will come back and say, these are all of the risks that you have, and this is the amount of premium that you can contribute to your captive insurance agency every single year, which is tax deductible. As time goes along, depending on what the loss ratios look like, there can be what's called an underwriting profit, where they didn't experience the losses that they anticipated they were going to, which creates a profit for the insurance company. Those profits can be distributed to the owner of the company, and when they're distributed, they come out as capital gains. So you can see the power of that from a tax planning standpoint. They took money that they were going to have to pay ordinary income tax on. They put it into the insurance company for legitimate insurance purposes. They needed to cover certain risks that the business had. But when the loss ratios are better than expected, they can then take distributions and underwriting profits out of the insurance company, and those are taxed at a capital gains rate.
Interesting.
Wow.
So what it sounds like is that to oversimplify it, it's a way to save money, some tax planning strategies, but also opens up another world of insurance and what might be covered, right,
Yes.
for business owners, which adds a ton of value.
Yeah, it does. And Congress has specific statutes that cover captive insurance companies. It's something that's been approved by Congress. So it's a very powerful tool for risk management and for tax planning. And they are very flexible. So, a surgeon can use them, a manufacturing company can use them, a retail company can use them, a high net worth individual. Essentially anyone who has risks or a large amount of risk can use a captive insurance to help cover those risks.
That's fantastic. And so I really appreciate you coming here today, Gabe, and talking to us about this. It sounds like most business owners, most high net worth individuals could benefit from something like this.
Absolutely.
That's great.
So here we are in the summer of 2020, either in the middle or at the end of a pandemic. We have all sorts of major cultural issues going on right now. So it's a great time to tackle business succession planning. James, could you tell us a little bit about what does business succession planning mean, and what are some of the pitfalls or dangers of not doing it or not doing it correctly?
Sure, absolutely, Gabe. Really, in the arena of business succession planning, the two major considerations are business ownership and business management. And having a plan in place that if you, the business owner and the business manager, become incapacitated and you're unable to manage or run the business, well, who's going to run it for you? And then, if you are deceased, who is going to run the business and who is going to own the business? Now, ownership and management oftentimes are the same person, but they don't have to be. And so business succession planning is about sitting down, putting pen to paper, and having some intentionality about appointing individuals and empowering them to serve in that management capacity upon death or incapacity of you, and then directing where the ownership will go upon your death. And so some of the pitfalls of not having a plan in place is, having the business interest and the business management to go to somebody that. And so, as a business owner, you spend all of this time creating this entity, and you want to make sure that it is stewarded to the next generation the way that you intend.
Yeah, from an estate planning perspective, business owners oftentimes have even more of a responsibility to have a plan and steward what they built and what God has given them in the sense that they've built this thing. So from an estate planning perspective, we really believe in business succession planning. Gabe, it really takes a team to get a solid business succession plan. It takes attorneys, estate planners, and then it also takes financial advisors. So within your firm, what are some of the ways that you've been able to utilize certain tools to help with business succession planning?
Yeah, I think the primary tool that I normally see used in the marketplace is something that's called a buy-sell agreement. And it is an agreement that governs how a business transition or a sell or some unexpected event, when that event happens, how things are going to play out. It's a very, very powerful tool. So I work with law firms such as you guys on the crafting of that actual legal agreement. And then our firm does the actual funding for it. So whenever these things happen, how is it going to play out? The two primary resources that we see used to fund it are normally going to be life insurance first, which is a great tool to provide liquidity in the event of one of the partners passing away or the owner of the company passing away. Life insurance is going to create liquidity, and it's going to create tax-free liquidity that can then be used to either operate the business on an ongoing basis or can be used to buy out other partners or partner inside of the business. One aspect that I see overlooked a lot inside of buy-sell planning is, okay, if the owner dies, you have the life insurance that covers that. If one of the owners becomes incapacitated and suffers a disability event, what happens then? The life insurance is not going to pay out. It's not going to provide the liquidity, but that partner still can't be involved inside of the business. So insurance companies have developed a special tool for that, which is a disability buyout policy. And that policy, in the event that one of the partners becomes disabled, would actually provide the liquidity in a similar manner that the life insurance would have provided to take care of the financial issues with a disability or one of the partners becoming incapacitated.
Yeah, that's fantastic, and you're right. We work with advisors like you all the time doing buy-sell agreements, and we draft them, and then you guys fund them. But a buy-sell agreement is a business succession plan that we utilize mostly whenever there are partners running a business and owning a business, and the desire is not for the family of a deceased partner to continue with the business, but the desire is for the existing partners to continue owning and running the business. So in that situation, we use buy-sell agreements all the time. Now, contrasted to that, sometimes there are family businesses where a business owner wants their spouse or their children to continue owning and managing the business. And in those situations, we often utilize trusts. Where the business owner's interest in the business gets transferred to a trust upon their passing, and then the family can continue operating and owning the business through the trust. Sometimes, as James mentioned, if they want ownership and management to be separate, then the family can inherit the interest in the business in the trust, and they can be compensated based on their ownership interest, but somebody else can manage the business. So really the sky's the limit as far as the way that you can build these things out. And I like what you said, that a lot of people plan for passing away, but they don't plan for incapacitation. So not only on the insurance side do you need to plan for incapacitation, but on the business succession and estate planning side you do as well. And that's where powers of attorney and well-drafted trusts with successor trustees, well-drafted operating agreements on LLCs and articles of incorporation, basically laying out who's going to manage and who's going to continue owning or buying out in an incapacity or a disability event. So really, we really utilize a lot of estate planning tools as well as business planning tools like buy-sells and operating agreements, and then we really rely on you guys to come in with the insurance side.
Yeah, and what I see a lot there is business succession planning is a topic that's ongoing. It's not something that you just take care of at one point and it runs perfectly from then on out. A mistake that I see a lot is they will go through, they'll do a buy-sell, they'll put business succession planning documents in place, but they won't come back and update those. And there can be family dynamic changes. There can be changes in valuation of the company. So it's something that you need to go through and take a very deliberate process working with the team, but you need to come back and revisit it almost on an annual basis to make sure that it's still accomplishing what the business owner or owners wanted to accomplish.
Exactly. And that's a great point. And I'll add, in speaking to the business owners out there, that as business owners ourselves, we understand what it's like in the day-to-day operations of the business and looking directly at what's in front of you. And it's sometimes easy to neglect some of these things that we're talking about. And so as small business owners, we have to sort of take the time and build a team around us and a team of professionals and advisors to understand what our options are and make informed decisions with the options that are presented to us, and putting a plan in place. Because speaking for our family, our small business is our largest asset, and so we have to make sure that when it comes to management and when it comes to ownership, that we have a plan in place, and that plan is fully funded and implemented the way that we intend.
Yeah, and we are business owners, but we're also have family lives, and we're members of family. So we have to make sure that our businesses and what's going on inside of our businesses will also flow in and talk to each other in a way that is congruent, and that the plan makes sense for both the business side and also for what the family dynamics look like on the family side.
Thank you so much for taking the time to watch this video. Really, our heart in making these videos is to add value to you as a business owner or as an individual or as a family, and to add arrows to your quiver. So hopefully you found some of this information valuable. I want to add that none of this information should be taken as legal advice. And so if you have questions about something that we discussed today, talk to your professional, or please feel free to give us a call and schedule a free consultation. So Gabe, again, thank you for being here. If somebody wants to talk to you and reach out to you and schedule a consultation, what's the best way to do that?
James, Matt, appreciate it. It was great being with you guys today to discuss these very important topics. The best way to reach us is via email at gp@stratlegacy.com, or you could go to our website, which is stratlegacy.com.
Yeah, and if you want to reach out to us, the best way to get a hold of us is to go to our website, www.yourtexaslegacy.com. It's got all the information you'll need on there, the numbers to all of our different offices, the email that you can reach. It's even got an info submission form where you can put your request for a consultation and what you're needing assistance with. So basically our website, all-purpose, www.yourtexaslegacy.com. It's been great being with you guys today.